slots let you roam seamlessly across 333 towns. Be Blue, it's simply better. Reliance.
Eyeball slide. I read my scripts, connect to fans, approve photos, watch movies, manage schedules, surf the net, or win at my favorite game. Terrific performance, sleek in design, and good to hold. Eyeball slide. Enjoy the ride.
We hope to be able to reach out to a large number of children who are not being serviced.
Our mission is to effect positive, sustainable change in birth practices.
This year, we should be close to about $20 million.
Witness the emergence of tomorrow's pioneers.
What an exciting set of entrepreneurs.
We had a bit of a tough choice because very unique businesses and many unique USPs in each opportunity.
Watch budding entrepreneurs vie for a rare opportunity to transform their business. Watch Pioneering Spirit, a product of Lufthansa, only on ET Now.
Who says light is the fastest thing in the universe? Blink, and you're watching a movie. Blink, and you're clicking like a pro. Blink, and you're racing ahead. Get the unbelievably fast new Zolo X900 with Intel inside. Zolo X900. Blink, and it's done.
₹25,000 crore. That's how much money Kenneth Andrade is responsible for as head investments at IDFC Mutual Fund. He directly manages a fifth of that cash pile, and a team of fund managers reporting to Kenneth take care of the rest. This former journalist has about 21 years of work experience in the financial sector and has worked in Kotak Mutual Fund and broking firm Sher Khan. He's been with IDFC Mutual Fund since its inception in 2005 and manages some of the fund's flagship schemes like IDFC Premier Equity, IDFC Sterling Equity, IDFC Enterprise Equity and IDFC Strategic Sector Fund. On the street, Kenneth is better known as a mid-cap specialist and has even been called India's mid-cap Mughal. A risky path to choose in these turbulent times, you would think, but Kenneth disagrees.
There's nothing to be worried about because it's been 5 years since the market has been consolidating, okay, but there's no way it's a bear market because you still have a very substantial number of companies hitting their all-time highs, lifetime highs, and all of that is followed by all-time highs in terms of profitability also. So it's just a case of rebalancing your portfolios as you take it in your stride.
Right now, especially getting into 2013, you're midway through 2012, you're going to be focusing on solvency risk rather than valuation risk, which is essentially the risk of high debt. How do you go about identifying companies, with that criteria in mind?
I think as we go into the next 2 or 3 years, okay, the choices between one, how do you play the cycle? One, you have valuation risks. So where markets are actually polarized capital today, whether you call them defenses or in other terminology, FMCGs, pharmaceuticals, IT, etc., a significant amount of those balance sheets are deleveraged, but you're paying a price for it. Okay, they're extremely high in terms of valuation. Till now, that played out. Okay, going into the next couple of years, I think the biggest story coming out of India is how the leverage cycle into the next couple of years will actually come down. Now to explain that a little differently, okay, the valuation of a company is fixed. Okay, now when the valuation of a company is fixed, it's determined by market capitalization and debt. Okay, and debt in some cases today is 5 times the market capitalization, and in some cases they're completely blown out of proportion. Okay, and that's the cycle where we believe you can make significant amount of money. Now, if that deleveraging cycle kicks in, valuation of the company remaining static, okay, how much market cap will gain as debts get spread down? Okay, so
you're looking at companies which are deleveraging or bringing down their debt.
Exactly. So today, as we stand, today the valuation risk is high. Okay, but the solvency risk can be identified. Okay, you can identify companies that are actually going down the cycle, or who can probably do not have assets to come back into the cycle. So it's reasonably easier to identify these companies. It's reasonably easier to identify as to how the debt will come off, and start building incremental portfolios from there. In other terms, financial leverage in the next cycle has to come back very strongly.
And you see that playing out 2013 onwards?
It's going to take some time. There are two components to how we're looking at equities at this point in time. Okay, one, we have historically always concentrated on earnings growth. Okay, and earnings over the next 2 years should largely be closer to the single-digit number. Our belief is that first, corporate's balance sheet has to kick back before the earnings growth cycle actually commences. Okay, so the first change that will happen in corporate India when 2012 is gone by, but 2013 balance sheet, first change that you'll see is balance sheets getting, promoters and corporates actually getting a control on their balance sheets.
How do you go about identifying these companies? You know, because there are a lot of companies in this market which would be having high debt. What are the kind of ratios or filters that you put in place to identify companies?
They can come from any industry. Okay, we largely look at the investment economy to figure it out. To say that these are the businesses that have been highly leveraged. But if you look at it just in the past, from 2009, when the crisis first hit us, we've got a couple of pharma companies that went through that cycle. Okay, and they've created a lot of market capitalization at the expense of debt being paid down. So it's not something that we haven't seen before.
You've also spoken about how you're looking at companies which are looking at expansion in this cycle. What kind of expansion will convince you that this company is going into the next league?
I think if I put it all together, you've had a very large growth in gross block that's come through. Okay, we did if you just look from 2006 March and BSE 500 companies, they closed the year with about 8 lakh crores of gross block. Capital employed, not gross block, capital employed. 2011 March end, this number moved to about 29.5 lakh crores. Okay, so there is significant capacity that is already on the ground. Now that capacity is going to start generating capital. Okay, and that cycle needs to kickstart itself. So the environment has to be right, and if we can clip in with this 5 to 7% GDP growth rate, most of this capacity will continue to get utilized. So from an economic cycle standpoint, you just have to identify where in that economic cycle you are. Okay, and you are in that entire cycle of capacity being created, capacity will get utilized, cash flows will come back into the system, balance sheets will get deleveraged before you kick off into your next investment cycle.
All right, you've also stated that your way of looking at companies is not purely market cap. So it's not like if a company is large cap, you take special consideration for the company. So what's the starting point, since you've been credited for identifying some really value-oriented mid-cap stocks, which is the starting point for you to really spot those hidden gems?
Buy a good company, I guess that's where it starts from. But I think we're getting into an environment or a cycle which is completely different from what the past has been. So in the past, we've highlighted the fact that we stayed with companies which are in industry leaders. Okay, we stayed with solvent companies. Okay, and we've ridden through this entire cycle on the upside. I think the cycle in the next round is going to be completely different. So we are we are orienting our portfolios to look to migrate towards companies which have assets on the ground. Whenever the deleveraging cycle kicks off, we should be with that deleveraging cycle. So the standpoint is how can you identify what's going to lead the market in the capital markets in the next round, or what's going to lead the economy in the next round. Once you've been able to identify that, just find the components of that business or that trend. Okay, and allocate capital out there. So to an extent, we give a lot of emphasis on what should be the overall construct of the portfolio, and build it with companies that you are very comfortable with.
All right, what I've also seen in your portfolio when I study especially IDFC Premier, that without increasing the risk to the portfolio, you've been able to generate alpha. How have you managed to do that?
I think it largely stands in context to how we work. When we try to identify an opportunity, we do not go for the smallest company in the bouquet, irrespective of where valuation stand. Okay, and like I mentioned before, while we've been identified in the mid-cap space, we buy the largest company in that segment. So if you look at Premier right now, and you take each of the top 10 companies, they usually lead their industries or segments. They lead their industries or segments. Second part of it is none of these guys will ever come in the top end of the portfolio. They'll all come from the bottom end of the portfolio. So whoever gets to the top 10 or the companies that are there in the top 10 have actually earned their right to be in the top 10. Okay, so that's a little bit about the portfolio that we've actually constructed.
But what are the risk factors do you identify to ensure that the overall risk of the portfolio is not going up?
It's purely stock selection, I think, and it remains with that. And if the companies actually pay through, I think we've been able to deliver what we've done. So I mentioned that our entire focus is about getting number 11 to number 30 right. And if you get a 65% probability out there of companies getting there, I think that replaces your top 10 in the next cycle.
Right, Kenneth. We'll take a short break on that note. In fact, when we come back, we will understand from Kenneth his specific fund philosophy. Stay tuned for that.
Find old mails instantly on Gmail. Be Blue. It's simply better. Reliance.
I know you wanna pimp my ride. I know you wanna be inside. But now
Score a lot of BRS. Play on.
Samsung Galaxy S3. Designed for humans.
One club sandwich. Your treat, na?
हाँ, दिल बड़ा होना चाहिए.
Then one risotto, one grilled salmon, and no, 2 tiramisu.
What?
Fine, 1 tiramisu.
नहीं यार, मेरे इंटरनेट डोंगल का बिल देख, 1000 रुपीस एक्स्ट्रा.
Risotto.
और ये देख, सिर्फ 300 MB एक्स्ट्रा यूसेज.
मेरे नेटवर्क पे होते तो एडजस्ट करके लोएस्ट पॉसिबल बिल आता. कम यूज करो या ज्यादा. सामन
कैंसिल.
अरे बट
तो पहले अपना बिल छोटा करो, बिल बाद में बड़ा कर लेना.
Reliance Net Connect का My Best Plan. It's simply better. Reliance.
Welcome back. We're still in conversation with Kenneth Andrade of IDFC Mutual Fund. Kenneth, let's discuss specific funds, starting off with the one which is most popular, which is IDFC Premier. The one thing that stands out in the fund is your weightage on services versus the benchmark, which is about 13%. Why is that? What's the conviction in the sector?
Okay, I guess services as per AMFI definition, or the definition that we've been looking at, includes a significant amount of logistics, some part of FMCG services, etc. And I mean, the reasoning is essentially pretty simple. It's a business that didn't require too much of capital to be employed, and you've had historically high growth rates. So those businesses just migrated towards the top of the portfolio, and they've stayed there.
But some of the services business that I see in your portfolio have high gestation cycles. So how do you play that out? I mean, where do you draw the growth value balance and identify the entry point for a services stock?
No, most of these companies have been in operation for the last for as long as I can remember, and capex to most of these companies have been an ongoing situation. So it's not that they have a very long gestation cycle on their entire balance sheet. Okay, most of these guys do not need capital to grow. I think that's the starting point of everything. If you do not need capital to grow, in all likelihood you will return capital to the shareholder, and that's what we invest in, companies that return capital and not take capital from us.
But I want to understand that growth value trade-off from you a bit more, because when I look at your FMCG portfolio, I do not see the very obvious names there. The likes of a TTK Prestige or Jubilant FoodWorks is not part of the portfolio, but a Page Industries is and has significant holding. So how do you rationalize your the stocks that you pick on that growth value trade-off?
In the first round, okay, all these businesses tend to do well. So from the names you talked about and the names we have in the portfolio, the return and the return profiles are not divergently different. Okay, so we've been able to allocate money into all these names over a period of time, and some of the names that you've also mentioned, though they do not